Welcome to Yahoo Finance Live this Wednesday, February 1st. We are moments away from the Fed's decision on interest rates. Wall Street widely expecting a 25 basis point hike. Let's take a look at the markets here ahead of that decision. And we are looking at losses here with the major averages. You have the Dow off just around 296 points. Nasdaq under pressure off just about 0.2%. The S&P off nearly 0.5%. Taking a look at the bond market, yields edging lower just a bit here ahead of this decision, off about 6 basis points to 347, not drifting too far from that 3.5 line where we had really been trending for about a month or so now. Taking a look at the sector action ahead of this decision, it's a bit of a mixed, all in the red except for technology. You're looking at energy, the largest underperformer here, off just around 2.5%. Technology, though, Dave, barely holding on to gains.
Yeah, and largely speaking, the big names are largely holding their breath ahead of this decision. Not a whole lot of movement to the up or the downside, and you can see the names today. But really, the story has been how they performed this year. The Nasdaq outperforming the S&P and the Dow after it was battered last year, and a lot of these big names up. Huge. Tesla up 40% year to date. Apple's up about 10. Google's up about 11%. Meta, we are awaiting earnings for them. We'll get them after the break. We'll have full analysis of Meta earnings, up almost a quarter year to date. It's been an outstanding start. Amazon up 22%. Jen Schomburger now with the Fed has the decision, I believe. Is she not quite ready yet? Not quite ready yet. Do you expect this to continue is largely the question.
That is a huge question here. And we talked to one of our markets guests yesterday who was saying he doesn't necessarily see this as being a shift in sentiment. He sees this as a brief rally, and he expects some of these leaders to then retreat. He's not sold that tech is it right now. But let's get over to Jen Schomburger with that Fed decision.
Good afternoon. Rate hike. The Federal Reserve raising its benchmark policy rate by a quarter percentage point to a new range of 4.5 to 4.75%. That marks the highest level since October 2007. Now, in their statement, Fed officials acknowledged that inflation has eased somewhat, but remains elevated. They no longer noted, however, that the war in Ukraine is contributing upward pressure to inflation, rather just global uncertainty. Now, they did maintain language in the statement that, quote, ongoing increases in rate hikes would be appropriate to obtain a, quote, sufficiently restrictive level on the Fed funds rate, perhaps in effect countering that recent easing in financial conditions. Now, the Fed also noted that in determining the, quote, the extent of future rate hikes instead of pace, which was formally used in the former statement, that the Fed will take into account lags in monetary policy and the impact on inflation, the economy, and financial developments. Of course, this move marking a further slowdown from the 50 basis point rate hike we saw in December, and a further slowdown from a string of 475 basis point rate hikes in June through November of last year, which was the most aggressive stretch since the 1980s. This decision was unanimous. We will get more from Fed Chair Powell when he holds its press conference in less than 30 minutes' time. Back to you.
All right, Jen, and when we take a look at this, you mentioned the fact that ongoing rate increases, they remain appropriate. Inflation, though, has eased somewhat. We know a lot of the focus is going to be on Powell, what he says, the tone that he is using. What will you be looking to hear from Powell in just about 30 minutes from now?
I expect Fed Chair Powell to take a very hawkish tone. He is going to remain committed to bringing down inflation to 2%. While it has eased over the past 3 months, it still remains well above the Fed's 2% target. If you look at the Fed's preferred measure on inflation, that so-called core PCE clocked in around 4.4% in December, so still somewhat elevated there. So I expect him to talk tough on inflation, and especially if financial conditions remain easy or ease further. I think that could give the Fed license to continue raising at that point. And that's why I think you saw the Fed maintain language for ongoing increases, plural.
All right, Jen Schomburger, thanks so much for that. We want to take a look at how the market is reacting because you have S&P just around its lows of the day. All three of the major averages remaining in the red. The Dow off 300 44 points. S&P off just around 0.6%. You have the Nasdaq off nearly 0.5%. We want to bring Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. We also have Mike Puglisi, Wells Fargo Senior Economist. Mike, let me start with you just in terms of the market's reaction here. S&P just around the lows of the session. What do you make of the Fed decision and some of the language that has remained in this statement? Ongoing rate increases appropriate?
Yeah, well, thanks for having me. And I think the way I think about the statement right now is it may be a touch hawkish, but largely in line with expectations. It wasn't my view that this was going to be the last rate hike. We've got another one penciled in for March, and then one more final 25 basis point rate hike in May. So I think at least one more makes a lot of sense. And that's what was reflected in this statement. Taking a step back from the path of policy more broadly, I think this is really a bide their time meeting for the FOMC, where we've got 2 more CPI releases between now and the March meeting, 2 more employment releases. Obviously, March will also have an update to the dots and the economic projections, which today's meeting does not. And that's really, to me, when the rubber is going to meet the road for the Fed, when they need to decide, will we hike one more time? Are we going to sit on hold for a while? What do we want to project for the rest of the year? Right now, I think this makes sense with the Fed that's, feeling good about where the data is heading, but, they don't by any means feel that it's mission accomplished yet.
All right, Kathy, let's get your reaction to the announcement. And this is what we do. We overanalyze language, so ongoing increases. Does that suggest to you there are 2 more after this 25-point hike?
I think that's likely. I think the Fed's made it pretty clear that their target for the peak Fed funds rate is probably 5 to 5.25%, and that probably will come in 25 basis point increments between now and the spring, unless something changes pretty drastically. I think that that's what they've been signaling pretty clearly. Any hopes that they might be somewhat more dovish, I think, were probably unrealistic at this meeting. A lot depends, as things go forward. But I think that this was largely as expected and largely in line with what the guidance has been so far from the Fed.
Kathy, the case, though, for holding rates higher by the Fed, is that case becoming less compelling to you given the recent data that we've gotten?
Yeah, absolutely. So the Fed has talked about, hike and hold and then recalibrate. What we're seeing is a lot of information suggesting that indeed inflation's coming down, that some of the things that they really worried about accelerating or not accelerating, actually moving in the other direction. So I think had it not been for the Fed being so far behind the 8 ball in terms of starting this cycle, they probably wouldn't have to raise rates as much as they're planning to, because we are starting to see wage gains slow down. We're starting to see manufacturing is still very soft with input prices declining and output prices declining, new orders declining. We're seeing some cooling off in consumer spending. And certainly in the global markets, we're starting to see, some of the things that were worrying the Fed and other central banks, like high energy prices, have gone in the other direction. So there's plenty of compelling reasons for the Fed to slow down at this stage of the game and even probably could build a case for stopping. But they have signaled so clearly that their goal is to get to this 5.25% and hold it there for a while. If they back off, that's probably going to be a signal that they, are easy on inflation, and that's not the signal they want to send.
Of course, that pivotal Friday jobs number, Mike, could change everything. And how do you think this morning may have jolted, if you will, pun very much intended, the Fed, 11 million job openings?
Yeah, I mean, it's certainly going the wrong direction, but I wouldn't put too much emphasis on the headline openings for a couple reasons. First, when you dug under the headline of that, a lot of it was concentrated in a few industries, which maybe suggests some seasonal quirks or some other issues. So it was retail, trade, leisure and hospitality, construction. It wasn't necessarily a very broad-based increase in job openings across the economy. And you also saw quits edge down, which was another sign that I think was more consistent with some gradual labor market cooling. So, the headline wasn't necessarily super consistent with other labor market indicators of demand. It wasn't consistent with the ECI report we got yesterday. Obviously, we'll see what employment report on Friday holds. But, at the end of the day, it's not necessarily what the Fed's looking for at this point in time, is even higher openings coming off a high base.
Kathy, let's take a look at the bond market's reaction. We're still off just about 6 basis points, not too far from 3.5. But I'm pointing this out because in 4 of the last 5 Fed rate decisions, the first move in the 10-year was actually reversed within the next half hour once Powell started speaking. Do you expect that to happen again?
Oh, I think it's a risk. I actually think it's more of a risk at the short end or the intermediate part of the curve, because that's where the market is not priced for the Fed to hit that 5.25 peak rate. So when you look at where 2 and 3 year yields are priced right now, they'd have to, really come down pretty quickly in order to meet those expectations. So I think if there's a repricing in the market, it's more at the short end than it is at the long end, which really is going to reflect the expectation for slower growth and inflation. And we have this steeply inverted yield curve. The more the Fed ratchets up the tightening at this stage of the game, when there's already evidence of slowing inflation, probably the deeper that inversion is going to be. So for 10-year yields, probably bounce around this 3.5% area. We'll wait and see what the data are on Friday for the job market. That's probably going to be more of a driver of bond yields than what happens today.
And Mike, what are you in particular going to be listening for when Jerome Powell starts talking in about 20 minutes?
I think what I'll just be listening for is, does he push back on anything in terms of how the market's positioned right now? It's not my base case, sort of like I already said. I think this meeting is more about biding time, trying to get a little more data before going into that important March meeting. But I mean, there's always a risk that the Fed views things differently, right? And so you still have just almost some event risk going into the press conference of maybe the Fed sees this differently and they really want to push back on market pricing for, interest rates like Kathy was just discussing, or maybe the rally we've seen in risk assets. So that's really, I think, what would catch my ear is if the Fed is thinking about this a lot differently than the market is right now. Whereas I think what's more likely is you'll just get a Fed that tries to punt to some extent, going one way or the other on financial conditions.
All right, Mike Puglisi, Kathy Jones, thanks so much for joining us here. We want to stick with the market's reaction. Now we are mixed. The Nasdaq actually in positive territory, up just 15 points here, but the Dow off its lows of the session, now off just about 260 points. We have Brian Belsky, BMO Capital Markets Chief Investment Strategist. Brian, it's great to see you again. We had you on the last Fed decision day. Here we are about a month and a half later. What do you think of today's decision?
Oh, Shauna, thank you so much for having us. The market really wanted to hear something they didn't know. Tell me something I don't know. And the Fed did exactly the opposite, just said exactly the same thing. In these preambles, the half hour prior to the Fed actually speak is just nothing but conjecture, because we don't really know how hawkish he's going to be. Now, our bet is that he continues to be hawkish. And he didn't really like that risk assets have gone up in January, but that's okay. We all know that the Fed's path is beginning to slow. That trend is beginning to change. I think that's what the market is looking at, whether or not it's one more 25 basis point in March or 2 more March and May. From our vantage point and from the longer term trend, it's a moot point because we actually think the lows are in place, that we're not going to see an earnings recession. And that the market is already priced in a recession, given what happened in the bad market performance we saw last year. So again, the trend is toward the end of the rising interest rate cycle, and I think that's the key takeaway.
Good to see you, Mr. Belsky. You got to play the game for us. Ongoing increases. Tell me what signal you think Jerome Powell is sending by sticking with that language.
Well, I think not unlike everybody else, Briggsy, no one can understand this employment situation. It's amazing, because the textbooks would tell you that, the market goes down 20%, earnings have to go down 20%, and then we need to see a spike in unemployment. We're not seeing that. And I think it's confounding the Fed. And I think the Fed received so much negative feedback last year that now they're probably overstaying their welcome, quite frankly. But at the end of the day, from our work, from an earnings recession side, we're not seeing it. And I just don't understand how and where the big spike in unemployment is going to come from, which would actually cause the Fed to reverse notion. Maybe we just kind of settle in here, and maybe the Fed just has to live with that being what, quote unquote, would be normalization of employment.
So, Brian, then what does all this mean for equities then this year? You mentioned the fact that earnings recession, it doesn't seem like we are seeing it, at least from the reports that we've gotten so far. So what does that signal just in terms of what's ahead?
It means quality, 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 cash flow, cash flow, cash flow. I think it is very, very prudent to remain neutral, meaning market weight technology, because there's a lot of great parts of technology you can, will, and should own. Shouldn't own just a blanket technology ETF, I think. I think you need to own stocks. That's kind of number one. And number two, I think from a contrarian basis, if you're looking for names that the market has hated but maybe have a big theme around it, we love the communication services sector from a thematic perspective in terms of, we call it the 3 C's of communication services: cash, content, and consolidation. I think the streamers are going to consolidate. And when you're looking at matching up a growth and value stock within a portfolio, there's no better sector than communication services. Overall, though, for the first time in over 10 years, we're overweight small mid relative to large, because we see a big displacement with respect to valuation, but also earnings growth and discernibility is very strong within the small mid cap space. And then lastly, value, Shauna. I think this isn't going to be a binary environment where you have to own either value or growth. I think you can own both. But from a fundamental perspective, you want to look at fundamental value, debt to equity below 1, earnings that are above the market in terms of growth rates, PEs below the market. But you can also own a little GARPy growth at a reasonable price as well.
Very casually snuck in some potentially huge news later this year as you talk about consolidation of the streamers. I like that tactic there, Belsky. Who could consolidate? Who could be the winner?
Well, listen, I like not unlike all other Americans. I'll get like 10 streaming services. It's too much, right? So the winner, and the one that we've stayed with all along and received a lot of negative press about it, is Netflix. I think Netflix is the Kleenex of streaming. Bottom line, period. Best run, cash flow. Now they're going to advertising. Fantastic. They will be the core, right? I think Disney is going to be part of the core. What happens to Peacock and Paramount Plus and all of these others, I think, remains to be seen. And so I think that's kind of where you want to look with respect to potential consolidation, especially given the fact that the content is becoming much more expensive in the streams and how we're going to deliver that content. Netflix has got it right.
So we got what you like a lot. What about what you don't like? What do you say to investors right now, your clients, that they should avoid, at least in the short term?
Oh my gosh, that's a great question. Utilities and consumer staples we just despise. And part of the reason why we despise it is that so many people have rushed into to both those sectors for defense. And consumer staples are one of the most expensive sectors in the market. It had the largest relative increase in multiple, Shauna, last year in 2022 in the history of the sector. Whereas you think about debt and bringing on debt and high valuation and long duration assets, well, the highest duration asset from our view with respect to valuation and debt are utilities. And there's always going to be a stock that does not fit that. But from a sector basis, we believe that utilities and consumer staples from a sector basis are the most riskiest assets in the S&P 500.
All right, Brian Belsky, pleasure as always, sir. Thanks so much.
Thanks for having us.
Good to see you. Let's take a look at how markets are reacting to the news. Yahoo Finance's Jared Blickery here with us. Jared, what are we seeing? Instantly they didn't like it and now coming back to earth?
Yeah, so it looks like a little green here, not a lot, but we'll take it. And actually the fireworks start in just a few minutes here, about 14 or so. So here's the Nasdaq, and you can see here is the 2 p.m. announcement. Initially we went down, now we're back up. A lot of times there are zigzags, including when Chair Powell takes a lectern at 2:30. What matters today is not only the close today, but also the close tomorrow. So you take yesterday's, that would be Tuesday's close, you compared it to tomorrow's close. If it's higher, well, that is a successful FOMC announcement, not necessarily from the perspective of the Fed, but from the average investor. Now, let's take a look at the sector action. Only tech in the forefront there. Notable because that has been a leading sector this year and one of the worst off last year's. And that kind of speaks to that paradigm that we've had where the Nasdaq is leading this year, leading the Dow, and it was the opposite last year. Energy taking up the rear there. But let's check out what's going on in the bond market. And not seeing a whole lot of movement here either. This is a 10-year Treasury note futures, basically where we were when we started the announcement. So I would expect that to pick up some steam when Powell takes some questions later on. And let's get to some other markets here, some other leading markets, especially in the futures. Let's take a look at gold. Gold really not moving. Now, gold has been on a little bit of a tear so far. It's up 5.5% year to date compared to where it's been over the last year, really regaining some of that lost territory. Copper futures, let me put this back to an intraday. Not seeing a whole lot of movement from Dr. Copper right there. And we got to check out Bitcoin. Bitcoin, very telling. I've been saying you want to know where the stocks are going to close. Watch where Bitcoin is moving into that PRESA conference. And it looks very squiggly right here. That's because this is a very small range for Bitcoin. Let me put a year-to-date chart here, and you can just see what I'm talking about. It's pretty much flatlined over the last week to 10 days. So if Bitcoin starts moving up in a big way, that could be a leading indicator. Down the same way. Don't have much more than that. You know, we look into these statements and we look into the charts with quite the color dye here, Dave.
It's really hanging on, though, Bitcoin. Really just
above 23,000 still, above 20,000. Can't complain.
Kathy Wood this morning reiterating a base case of 500,000 by 2030, right? It's just about what you'd expect. Jared, thank you, my friend. Let's check in now with former Federal Reserve Board Special Advisor and Dartmouth College economics professor Andrew Levin. Nice to see you, sir. So we'll give you a blank slate there, your reaction to the expected 25-point hike and the language, ongoing increases. What are your thoughts?
Well, I think that there were a few minor updates to the statement that they issued at 2 o'clock. The quarter-point hike was no surprise at all. So the real challenge here is for Chair Powell in a few minutes to explain more about their thinking. There has been a lot of economic news in the last few weeks. So it's really important for him to give an update how their thinking's evolving since the last time they met in December. Remember, 4 times a year the Fed issues a fresh set of economic projections, but this is not one of those 4 times. So it puts a little bit more weight on the remarks that he's going to make.
Well, Andrew, how has your thinking evolved since the last time we spoke? Because when we spoke then, you were saying 6 to 7% for the Fed's funds rate. That wasn't out of the question. Has that changed since we have gotten some economic data that has shown that the economy has eased a bit?
I think that there has been some good news, and so I try to keep an open mind here, not to get struck in a rut. I think the good news is that some of the measures of inflation, and even the latest measure we got yesterday on the employment cost index, there's some sign that nominal wage growth might be starting to edge down. I think we need to wait several more months to see some more employment reports to get a clear handle on it. It's complicated because there's a lot of different kinds of workers, and the workers who are coming back into the workforce. We saw it this morning in the latest. It's called the JOLTS report. Still, a lot of workers quitting their jobs, moving to a different job, probably because they want a cost of living increase and they couldn't get it from their previous employer. So the challenge for the Fed is that if workers continue to want to get cost of living increases for the big cost of living increases they've faced in the last couple of years. Firms are under pressure in a strong labor market to do that. Firms got to pass those costs on to into their prices. Then we see kind of inflation getting entrenched. And so I wouldn't rule out the possibility that the Fed still needs to raise further. But I think probably the latest data gives them some breathing room. Maybe they'll make one more quarter-point hike in March, and then maybe they can wait a few months to sort of see, is the service price inflation coming down the way they've been hoping, or is it staying too high and that they need to tighten a bit further to really make sure that inflation comes back to earth?
So we're about 10 minutes away from the most measured speech since Tom Brady's retirement this morning. What are you listening for, Andrew?
Well, I think that some investors have been really worried about the risk of a recession. The latest consumer data we got for December doesn't look so great. The distinction of is the economy just flattening out, kind of taking a pause, but it's going to pick up speed again, or does it look like it's teetering on the edge? And so I'm sure that Chair Powell is going to get questions about this today. kind of what do Fed officials see as the risk that the economy is going to slide into recession, and how is that influencing their policy plans? Those are going to be really important questions for him to address.
What do you think about the likelihood of a recession in 23?
I'm hopeful that that's not in the cards. The disposable income's actually been pretty strong, and that's of course helped as workers get cost of living increases, gives them some buffer. Another good news about the inflation that we saw in some parts of the economy has definitely subsided. And the rent prices are starting to show some signs of slowing down. So consumers get some breathing room on the cost of living, then that means that the income increases they get will go further. So hopefully people call it a smooth landing. I was a little bit skeptical about that a few months ago. I think there is some more positive signs. So one good case for the Fed is smooth landing and inflation continues coming down, and the workers have enough cost of living increases that wage costs start to flatten out. Bad cases for the Fed, which are still possible, is the economy slows a lot, but workers are still getting hefty cost of living increases and inflation's still stubbornly high. Then the Fed has to make some tough decisions.
Yeah, Andrew, let's talk a little bit more about the labor market and the dynamics at play there, because I think everyone's been scratching their heads trying to figure out the fact that it has been so resilient, what that signals in terms of what's ahead, if it in fact will ever break. And some Fed officials have voiced concern that prices could potentially reaccelerate because the labor market is so tight. How valid do you think those concerns are at this point in the economic cycle?
Okay, I mean, these are really great questions, and again, we'll look to Chair Powell to see what he's thinking. But what I would say is, first of all, we look at the weekly jobless claim numbers coming in week by week, and those are still very, very low. So there's lots of headlines about a few high-tech firms that are laying off workers, but for most of the economy, particularly in the service sector, they're desperate to hire. And in fact, this morning's report, the job openings went back up again. So a key distinction here in the economy is residential construction's lousy. The housing sector got hit really hard by the increase in mortgage rates. Manufacturing sector is facing some challenges. The service sector, they're looking for more workers, and that's where they need to give cost of living increases. And that's where the labor costs are a big part of the prices that those firms charge. So I would say that the labor market's strong. It's not overheated. And that's an important distinction. It means the Fed doesn't necessarily have to hit the brakes. If the cost of living increases can slow down a little bit as workers are catching up, then maybe this will all work out fine. The much harder situation is the one where inflation's still running 2 or 3 times the Fed's target. The Fed may have to do more.
To your point, these layoffs have mainly been isolated to the tech sector. We got some more news today out of the automobile sector. Other than Hasbro and 3M, maybe a handful of names, it has been where that's really just 2% of our workforce. Do you think they will begin to spread in the months ahead to the economy as a whole?
Again, I hope not. I will point out that Walmart, which is a huge employer, just announced a few days ago really big cost of living increases, which I think it's great. The people who work at Walmart deserve to get a decent pay. But those pay increases are on the order of 10, 15, and 20% for these hourly workers who used to get paid $12. Now they're going to get $14 an hour. It's still, these are not greedy workers here. They're just getting a fair pay. Okay. But the point is, Walmart is a sign of the service sector of the economy. The hospital workers, there's a lot of other workers who've had really big cost increases in their cost of living. They have to tighten their belts. And those workers should be able to get cost of living increases. That creates the challenges we're talking about with these wage price dynamics.
Andrew, what is your read on the consumer? Because the retail sales, they pulled back over the last couple of reports that we've gotten, down 3 of the last 4 reports. We've gotten some data out from Citi this morning of their credit card data showing that overall spending is at its weakest point that it's been since April 2020. How big of how material of a pullback are you seeing in the consumer data and what that signals?
Well, one of the challenges with this data is in normal times, when the economy is kind of humming along, we see normal seasonal patterns. So usually in the past, the consumer spending was very strong in November and early December in the lead up to the holidays. I think part of what happened last fall, for a number of different reasons, was a lot of that consumer spending happened in October and early November. Another shift that's been happening lately is people spending less on goods and more on services. So these things make the data more complex to read and more complex to interpret. As I said before, the consumer data definitely has shown some signs of faltering, but with disposable income remaining strong, I think there is a reasonable hope that consumer spending will be resilient this year, and that we're not that close to the edge of a cliff.
All right, we're going to have to leave it there. Andrew Levin, we much appreciate your analysis, sir. We are awaiting the words of Jerome Powell, the Fed chairman. We will take him live as soon as he begins to speak. Let's check on the markets and how they're reacting to the increase, the 8th in a year, and the language. Again, it's ongoing increases. Look at the Dow, down 320 points. Is that a session low, or right near it at least? You see the Nasdaq continuing to outperform, up, albeit very slightly, and the S&P also down just marginally. What are you looking forward to hearing? I feel as though, look, I'm going to play this game because I think it really is intentional that he used the same language as he did in March related to ongoing increases, leaving us to believe there is more than one after this, which I happen to believe there is another one this year. Yeah, increases. It signals at least 2 more, so it'll be interesting to see any more commentary on that from Powell. I also think just in terms of the fact that a lot of these changes, what a couple of our guests have been saying over the last half an hour, that the changes to this statement were pretty neutral, and maybe he was playing it a bit safe given the fact that we do have 2 more job prints ahead of that next decision. So we'll get a closer look at the labor market because we know the labor market has been so resilient up until now. When we were just talking to Andrew Levin, though, I thought some of his points were interesting because when we talked to him back in December, remember, he said Fed's funds rate could need to get to 6 to 7%. Now he's saying that maybe that is not the case. Maybe just 1 more hike will be needed, and then it's time to reassess. So I think some of those expectations have come down from the street. Are you in that camp? Just 1 more increase after this, and it's a 25? It's hard to make that with increases in the statement. If it's just an ongoing increase, get off the fence. I know. So you do think? Yes, I will say 1 more because I know you're saying 2. So I'm going to go with just 1. We'll see who wins that. Okay, fair enough. And hold until 24, and then begin to cut. Yeah, I think that's safe at least until now, until we start to see a material impact or material pullback in the inflation numbers. So, of course, something to listen to there. Fed Chair Jerome Powell is taking the podium. Let's head there now.
Good afternoon and welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from The Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December jolts this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in jolts has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent, we'll see more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, The Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it, is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex-housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria. Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina, and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee. So
the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're going to write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect. which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael. Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator, of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. We've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job, and it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time. But we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue, and once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this, and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are. We pick that up in conversations, and I've seen some data too that show people are, gradually they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses that essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Greg.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get closer to that drop-dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Fed Chair Jerome Powell wrapping up his first press conference of the year. Let's take a look at how the markets are reacting to this and still holding on to gains despite the fact that Fed Chair Powell reiterated time and time again that more increases would be necessary in order to get inflation under control. You're looking at the Dow up 45 points, flipping back into positive territory during that press conference. S&P up just about 1%. The Nasdaq now up nearly 2%, Dave. And all this coming time and time again, Fed Chair Jay Powell saying that the risks here is just about doing too little rather than doing too much, and saying that more increases are certainly necessary at this time.
Largely speaking, very similar to prior speeches, almost word for word, as he just reiterated there. They have taken COVID out. They no longer think it is a serious impact on the economy, but with the exception of that, and saying, really making clear that they have to raise the debt ceiling. This is largely the same speech we have heard going back a couple of Fed meetings now. And look, this is an economic Rorschach test. The markets see what they want to see, and they see a butterfly in that speech. I think a lot of people might see a bat. I hear what you heard, that it sounds in all likelihood, although he punted, largely speaking, on keeping in the language of ongoing increase. He was asked twice to confirm if that meant multiple increases are still coming after this 25-point hike, which, by the way, is the 8th in the last year. He punted twice on saying whether or not there would be multiple coming. I don't know what to you is raising. Let's just look at the Nasdaq, most sensitive to interest rates. What to you is justifying a 2% increase?
I think that the fact that he left the door open, he wasn't committal just in terms of how aggressive the Fed was going to get. And this is what, like you were saying, certainly similar to what we've seen in the last couple of Fed decisions, the last couple of conferences. The markets hear what they want to hear, and they hang on to any sort of optimism, and we're seeing that playing out in the markets again today. Some comments about the jobs market really stuck out to me just in terms of what exactly needs to happen. Powell saying that the labor market is still extremely tight, and he was saying that there are some signs of improvement. That labor cost report that we got out earlier this week, he called that, quote, constructive, but he did remain the fact that maybe we could see improvement in inflation easing without massive destruction here in the labor market, something he's reiterated time and time again.
On the flip side of what you're seeing in the markets, this stands out to me. We will need substantially more evidence to begin cutting, substantially more evidence. He added the risk to them, and he has reiterated this for several meetings now. The risk to Jerome Powell is doing too little, and he's been very clear they'd rather overdo it than underdo it when it comes to these increases. A lot of work left to do, and we don't see disinflation in that services ex-housing sector, and that is why they will continue to hike. And look, sounds to me, to one person, like there are 2 more increases, but the markets don't hear that.
Yeah, the markets don't hear that. They don't want to hear that. Powell saying that the global picture is improving a bit. Inflation comes down. Sentiment, he says, is going to improve. Let's talk a little bit more about this. We have Powell's press conference here that just wrapped up. Lisa Erickson, U.S. Bank Senior Vice President and Public Markets Group Head. Lisa, I want to start with comments from Chair Powell here on the possibility of more rate hikes and get your thoughts on the other side. Let's take a listen.
Continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time.
Restrictive stance for some time, but of course, Lisa, he did say he wasn't committal in terms of the Fed funds rate and exactly what that is going to look like here for the remainder of 2023. Some are viewing this, looks like the market at least is viewing this as more dovish than maybe some had anticipated. What's your reaction?
So to your point, Shauna, the Federal Reserve was really quite firm in both its statement as well as its opening remarks, really just focusing on the fact that the job is not done, ongoing increases, and really emphasizing that they want to make sure that that inflation rate comes back to the target of 2%. What happened, though, as the press conference was evolving is as some of those questions were asked to clarify the way forward, there was some more nuance in terms of looking at the underlying data. So, for example, noting that while financial conditions have eased in the short term, the Fed is really looking at it on a longer term basis, and so therefore was perhaps not as hawkish as it could have sounded on that matter. In addition, noting that there are countervailing forces on the labor market, while again it's not fully normalized yet, noting that we've made some progress. And so what I think you see is the market's reacting to some of that lack of clarity and the push and pull of data as some of those remarks were clarified.
Lisa, does the market reaction surprise you?
So initially, when the statement came out, I would have guessed that we would have had a more strong reaction from the market, just in terms of the reaffirmation that the Fed, again, is very committed. However, in light of some of these clarification questions and hearing that the Fed is, debating some of these push-offs and trade-offs, it isn't surprising that the market is rallying, and you do have some momentum in terms of, the positive sentiment that has increased. And so that combined, again, with some of the lack of clarity is giving the market room to run.
Lisa, what about the comments from Fed saying, from Fed Chair Jay Powell saying that he continues to think that there's a path to getting inflation back to 2% without a significant economic decline or significant decline in employment. Do you agree?
Well, certainly there are possibilities that we may have more of a soft landing on the horizon. When we look at just recent numbers, even this week, in terms of how the manufacturing and goods and services sectors have been evolving, what we see is that consumers actually have remained relatively resilient, even though there's been some signs of softening, and businesses are still spending. Again, some of the reports, not just on the macro front, but from companies across the board, are indicating there are ongoing investments in CapEx. And so with that, and the fact that we started this recession in a relatively strong economic and financial condition versus prior downturns, certainly, again, more of that slower growth scenario is possible as opposed to a very difficult recession.
We've talked about what the markets expect, Lisa. What is your expectations in terms of further rate hikes this year and when, in fact, they will begin to cut?
Well, we're still cautious overall on risk on assets and stocks, and simply because, again, it's not clear the trajectory of interest rates. And certainly the Fed has continued to emphasize, despite the market reaction, again, its commitment to remain restrictive. On top of that, you have the fact that even if there is a pause sometime later this year, monetary policy does act on a lagged effect. And so you have the situation where we're likely to see some continued softening, both in economic indicators as well as company earnings. And yet the market is still being relatively optimistic on what's going on in terms of how to price out company multiples. So that really does give us reason for caution, because we do not see necessarily a path clear towards easing conditions.
So, Lisa, what do you think this all means then for equity behavior, then, at least in the short term, as we do wait to see all this worked out? Do you expect to see more of that volatility that we have become accustomed to?
In the short term, what we really see is we're in what we would call a shoulder period. So if you step back and take a bigger picture perspective on what's happened over the last period since we've been in this unusual situation of the pandemic and reopening, we had a first repricing where essentially the stock market fell as multiples came down and interest rate increases really began to take effect in the economy. Now what we see is we're really in a period where people are hopefully anticipating an improved monetary policy environment. And so again, there's that positive sentiment, despite the fact that we're still seeing slowing in a number of indicators across the board. We do still see, however, wedged on either end of that shoulder period, again, the potential for what we would call a second repricing, this time, again, based on earnings continuing to come down. And what we see is that while those estimate revisions have begun for 2023, they still seem relatively high, again, just given the amount of decline we've seen in activity and the lagged effects of policy.
And so, Lisa, as we close, how do you position yourself? How do you invest into that backdrop?
Right now, we're urging our clients to be cautious, and that means really being relatively underweight equities and then overweight higher ballast types of asset classes like higher quality fixed income and also real assets. And both of those latter two asset classes, what they have in common is relatively higher income that on an ongoing basis, as you receive that, can buffer the portfolio from underlying price declines.
All right, Lisa Erickson, U.S. Bank Senior Vice President and Public Markets Group Head. Thanks so much. Really appreciate that. Coming up, Peloton shares soaring on earnings, but one analyst is not so bullish. He tells us why. FedEx and Rivian are two of the latest companies to announce layoffs. We'll have the details. And Meta will be in the earnings spotlight after the bell. We'll bring you the numbers and analysis as soon as they break. Don't go away. All right, the breaking news. Jerome Powell just gave that speech after the 8th rate increase this year, 25-point basis hike, and he reiterated that language from March of ongoing increases. Our own Jen Schomburger is there. She was there for the entire speech. Jen, nice to see you. What was your biggest takeaway from the Q&A session?
Hey there, good afternoon, Dave. Yeah, Fed Chair Powell striking a hawkish tone yet again, saying that while inflation has come down the past 3 months, they still need to see more substantial evidence that it is coming down on a sustained basis. Fed Chair Powell saying there's more work to do and that the Fed could raise rates higher than what was previously projected back in December of that range of 5 to 5.25. Take a listen.
We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Powell said we could get back to 2% inflation without a significant downturn in the economy and without a significant spike in the unemployment rate. He says that the committee right now is, and that I should note, he does not see cutting rates this year. He reiterated that again. Now, Powell said the committee is not exploring resuming raising rates after pausing, as Dallas Fed President Lori Logan had perhaps indicated in a recent speech. On the wage price spiral and the potential there, he agreed with Vice Chair Brainerd that he does not see a wage price spiral right now, and it's less of a risk, and that as inflation continues to come down and people see that, then that could help with sentiment there as well. Now, Powell did address failure to raise the debt limit, saying there's only one way forward, and that is for Congress to raise the debt ceiling, that any deviations from that path would be highly risky. He says this is a matter to be resolved by Congress. This doesn't involve us. He ultimately believes Congress will act on this. Back to you.
Jen, what about the comments in regards to a recession? Because it seems like Powell once again remaining pretty optimistic, saying that there was a good chance that we might be able to avoid one.
Yeah, he seems to have a different outlook than the market does. He says his base case scenario is that we basically have that soft landing where the unemployment rate doesn't spike that much and the economy doesn't have a significant decline. To his credit, that is what we're seeing right now. There are some signs flashing red, though. If you look at the manufacturing data out this morning, we'll get a jobs report on Friday morning. So we'll see how this goes. The Fed has projected just 0.5% of growth overall this year, but that would still technically be positive. So Fed Chair Powell very firmly staying in that camp right now of no recession this year. Of course, we'll see how things play out. The private sector certainly believes otherwise.
A hawkish tone, but the markets see it otherwise, don't they? They are very much in the green. Jen Schomburger, great job. Thanks so much. Speaking of shares soaring, Peloton having their best day in 4 months. Look at these numbers, up 25%. The company releasing its second quarter earnings report. Their CEO, Barry McCarthy, who's been on a year-long hill ride, telling investors in a letter today, quote, "If you've been wondering whether or not Peloton can make an epic comeback, this quarter's results show the changes we're making are working." Let's discuss this with BMO Managing Director Simeon Siegel. Simeon, nice to see you, sir. Epic comeback. Has it begun?
Great terminology. I'm just realizing, I think Barry and I were wearing similar clothes. So who wore it best over here? We're getting a nice little, I think it's him.
You, sir.
Listen, there you go. So listen, I think that if this was a traditional discretionary brand selling things, what we would be saying today is this company beat revenues to their credit. They've cut expenses to their credit, but they also missed gross profit dollars. So we would be asking about what is the quality of this sale. And I think that's important. But I want to stress, this was a company that was down in the dumps. People were worried about it. They beat their number. That is the headline number. But we would be asking about that quality of sale. the immediate response should be, well, it's not a traditional discretionary brand because they also have the monthly recurring revenue that comes from subscriptions. I think for that, we need to ask, subscription revenue was actually down sequentially. And there's a timing element, but you have to ask the question for a business that's predicated, again, it's not a small business. It's $5.5 billion today of market cap. Why is that subscription revenue either flat, down a little bit? Why isn't it growing? And so these are, I think, the questions where we have to internalize. Epic comeback effectively speaks to growth. I think what the company has done really well is restructuring and fixing a turnaround. I think we are far away from seeing growth.
Simeon, what do you make of the comments that we got from McCarthy just about questions about the viability of the business? He said that those questions have been put to bed. Do you agree with that?
I agree. I do. I think so. I think that there was questions last year about existential risks to the Peloton brand and company. Sorry, more the company. I don't subscribe to those, but I haven't subscribed to those in a while. I think that the question here is what it should be worth. I think, listen, Sean, I think you and I have talked about this for a while. I think what's fascinating is if someone was sleeping the last 3 years and they woke up and they just started reading about this company called Peloton, and they knew that it was started as a startup not long ago and now it's valued at the market at $5.5 billion, it would be viewed as a tremendous success. The problem is that we didn't fall asleep. We watched it do this. And so the perception that, oh, the company has been knocked down, I think we still need to internalize how many companies are not worth $5.5 billion. And so that's where I think there's a long way in between lack of viability and $5.5 billion. I think that's the conversation to be had.
How do we need to view them? It sounds as though we almost view them as a streaming company moving forward. That's where their margins are. They're losing money on the bikes.
They are losing money on the bikes. I think there's no way around that. And that's why I say that subscription revenue needs to be going up. And so the big question, obviously, right now is going to be, what does this member count look like a year from now, 3 years from now? We were looking at something that's interesting. The amount of subscribers within their first year is the lowest percentage of the total base that has ever existed. That's an obvious comment because during the pandemic, you were doubling your member base every year. You're now not. The problem with that is you're probably more likely to churn the longer you've had the bike. And so within that context, I think we do. Right now, churn was okay. Churn was a good number over here. It was in line with what they expected versus the prior, but still not bloated. But we're going to have to watch that, right? Because the point about streaming is you don't have to worry about bringing in that new dollar every day as long as the person stays with you. We like talking about CAC because it's a good sounding acronym, but cost of retention, CRC, doesn't sound as good. But that is important. And so I think absolutely. The question will be, what do you pay for a streaming business here? What is the ultimate TAM?
Yes, so what do they need to do then to get the more subscribers, to get more members on their side involved with Peloton? Is it lowering the price? Is it something else that they should be doing that they haven't done for the last 12 months?
So what are rules of engagement here when we're doing this virtually? Am I allowed to throw this on you guys and say, hey, do you both have a Peloton? Are we allowed to play that?
We both do.
We both do.
When did you get it?
During the pandemic, 2020.
Pre-pandemic.
So the question is, if you bought a pair of pants during the pandemic, you can buy another pair of pants next year. You both have your bikes already. Maybe you get a tread, maybe you get a rower, maybe you already have them. That doesn't have a subscriber. And so the dynamic, the problem with recurring revenue is that you need to find someone new. And so I think there might simply be a point at which Peloton has obviously pulled forward a tremendous amount of that capacity, of that demand. Will there always be new demand? Yes. Will it be to the amount? Is that 100 million number that has been thrown out there, does that seem feasible? Not based on the order of magnitude that we're growing today. And so what's interesting is one of the responses that CEO McCarthy is talking about on the call is this notion on the digital app. Right now, it's declining. The argument here is this is, I think, the line. There's a lot of fun words out there between Epic comeback, between the Powell comments you were just making, and I think path to the promised land was the term used for the digital app. We need to see that change, but that's a very different business than the bike. There are a lot of digital apps out there, and the churn is much higher. So I think that path, what do they need to do? I would actually argue what they should do is focus on on these brand loyalists, focus on the people that love the community. I also have a bike, by the way. And actually maybe raise price, right? Get the most you can out of the people like us that love the product. Because at the end of the day, luxury brands don't focus on selling everything to everyone. They focus on maximizing every unit that they drive. And I think that's going to be the question. Every brand has to determine balancing exclusivity and distribution. Netflix might not need to do that. Big streaming businesses might not need to do that. As soon as you introduce inventory, and halo and luxury and brand image, that conversation changes.
Underrated part of the app is the meditation side of it, which I use every day and sometimes twice if you need a little tip there, sir. An interesting letter from Blackwell Capital, though, and I'm sure you've heard about this, to Peloton, suggesting some of the companies that would be better stewards that should buy Peloton. They threw out Apple, Disney, Sony, Nike, a number of tech streaming, metaverse, and sportswear companies. Could they be purchased this year, and who would be a likely candidate?
Great question. Could they? Listen, everything could. I think the question is should they, and the question is when and why, right? Why hasn't it happened yet? And so if I think about it, one of those companies, right, if we just quickly go through those companies, one of them is Nike. We have found the athletic brands, Nike, Under Armour, Lulu, all bought connected fitness, and all of them have either walked away from it or written it down. I think we've talked about Lulu's mirror purchase has gone less than they've hoped for. So I don't know that the athletic businesses want to get involved. Amazon is obviously already connected with the business. Amazon, on the other hand, is in the business of moving a lot of product. That's not brand enhancing. So to the question of if they believe the TAM is large, but the brand can be eroded while doing it, then potentially, right? But what does Amazon get that they don't already have right now that they're already selling the product? So that's them. Apple, from a branding perspective, I guess makes sense. I think the question I've always wondered, and I don't cover Apple, has always been why wouldn't they have picked up this company earlier, right? If we're talking about just order of magnitude where Apple was during COVID and where Peloton was during COVID, Peloton was up and to the right. Peloton had the eyeballs of everyone that they would have had. The engagement now has declined. The perception now has declined. So if you didn't buy before, are you looking now? Again, I don't know, but just throwing out the thought process that at least I would have when thinking about this. I think right now Peloton's doing an excellent job flipping their own problems, working on the restructuring, cutting fixed costs. And I think the question is, does that lead to growth or not? You can be a healthy brand. You can be a smaller brand. And the reality is right now you're getting a lot of credibility from Wall Street at $5.5 billion market cap. It's worst things in the world.
I keep nudging Netflix to buy them, but they're not listening, my friend. You cover Nike. You mentioned Nike. Have to get your thoughts on what might be the greatest collaboration in the history of fashion. Tiffany & Co., Nike's Air Force Ones. They come out March 7th for $400. The little blue shoebox. That is just glorious. Have you seen these things? What do you think?
Yeah, we saw the social drops that happened over the weekend, and like any sneakerhead, I guess, got very excited. Listen, Nike's had collaborations are the best gift to the retail world, because collaborations, whether they're Nike and Tiffany or whether it's Supreme putting their logo on an Oreo, just is the beauty. We talk about the branding with Peloton and just human psychology, right? It'll sell out. It won't be needle moving to Nike. But the point is, this is what they do. And they've had really good relationships and really good collaborations with prior LVMH brands. So I think this, at the end of the day, is great for brand enhancement, great for marketing. We're talking about it now. Do I think it'll impact? Am I going to change my model based on it? No, but that doesn't make it any less cool.
But you want them, right? Let's be clear.
Want. Who doesn't?
Okay, good. Good. Just want.
Dave clearly does. It's the greatest collaboration in the history of fashion. That's a big endorsement.
I'll be on the sneakers app the second those drop, and I won't get them, but I will try.
Good luck. Good luck. You will not get them, but you can buy them on some reseller site, because some 12-year-old will be faster than you are.
Yeah. And for even more, double, triple that. All right, Simeon Siegel, thanks so much as always. All right, well, coming up next year, all eyes on Ticketmaster after Beyonce announcing details of her Renaissance World Tour. Should fans be nervous about getting tickets? We've got the details for you next. Time for a triple play. 3 stocks that we're watching in the final 15 minutes of trading. We have FedEx, Live Nation, and Foot Locker. Kicking it off with FedEx, the company planning to cut more than 10% of its management jobs and will consolidate more teams and also roles. FedEx CEO Raj Subramanian making the announcement in an internal memo. FedEx saying that the move is necessary to become a more efficient and agile organization. It's also going to, quote, align the size of the network with customer demand. Shares jumped today in midday trading. You're looking at it up just over 4%. It looks like the highest level that we've seen in just about 4 months here. So, Ali, we're seeing the wave of layoffs here. Not a significant number of FedEx, but certainly companies needing to adjust their workforce, needing to adjust their headcount in order to kind of, I guess, adjust to the current economic reality.
100%. And I was on the show yesterday and I said the word of the day that you're going to keep hearing is efficiency. And that is something that all of these businesses are grappling with. You've seen this in the tech industry. And the same problems that are hitting FedEx hit tech, right? You had this boom during COVID, everyone on their phones and computers. Now we're kind of leaving that COVID bubble, and now they're having to adjust their operations. Same thing with shipping and packaging. You had a lot of people ordering things throughout the pandemic. Now that is taking a hit to the bottom line. So this is something that we're just going to continue to see. When you want to streamline a business, easiest or quickest way, I should say, to do that is usually through layoffs. And at the end of the day, all these companies really want to do is be, no pun intended, irreplaceable. Because my next pick for
nicely done.
I'm working on that. Is Live Nation Entertainment, because Queen Bee, Beyonce, she's going on tour. But will Ticketmaster be able to handle the demand? After last year's Taylor Swift fiasco, Congress has ramped up its fight against Live Nation Entertainment, which lawmakers and competitors alike allege is a monopoly. Fans are already bracing for impact too, with one Twitter user warning the ticketing giant, quote, "Don't screw this up." And guys, fans don't want to have deja vu after the Taylor Swift situation. I had to get one more pun in there. But clearly all eyes are going to be on this rollout. You have to think Ticketmaster is already trying to think ahead. Considering that, shares are up modestly right now. But what do you guys think? You think they can handle it?
No, I think, is there a song I can use to say
I'm trying to think of one. I'm trying to think of one off
debacle?
the top of my head.
I don't know my Beyonce catalog enough to say, but it will be a disaster. It will be a debacle, whatever word you want to pick. I think the question is, will Congress do anything about this? Congress loves a shiny little object, and they love to take advantage of something that is hot as far as their constituents go. And once we lose track of that, once we follow another shiny object around the room, they move on. Will the DOJ break up Live Nation, Ticketmaster? I'm very pessimistic, although the Biden administration has really shown a tendency right now to go after these companies. They got a loss on Meta earlier today. Look, it is a monopoly. It's close to 80% of the ticket market. It fits the description in every way, shape, or form. Let's see DOJ do something. Are we skeptical?
I'm very skeptical. I don't think it's going to go off this ticket sale, and I also do not think they are going to be broken up.
I agree on both. And my play is Foot Locker. Ticker FL, shares jumping today after an upgrade from Credit Suisse to outperform from neutral and raising their price target to 62 from 38. The note reading, quote, "We see consistent evidence that the Nike relationship is improving, and we're increasingly convinced that the planned pullback from FL will be far less damaging than we initially expected." They added, since new CEO Mary Dillon started, we've seen consistent signals that the relationship has entered a more collaborative phase. The footwear retailer also announced earlier this week in a regulatory filing it has, quote, eliminated a number of corporate and support roles. Also expects to save $18 million annually as a result. Shares flat over the last 12 months, but off to a very fast start to 2023. And look at today, a spectacular performance off of this news, up 4+%. Looking like Mary Dillon is leading quite the turnaround in a very short period of time. She just showed up.
Yeah, and there was a lot of optimism. We saw it in the stock's reaction after she was named CEO. So really following through on that excitement, making some necessary changes that clearly Foot Locker had been needing now for quite some time. Credit Suisse isn't alone. They're one of 2 buy ratings on the street right now when it comes to Foot Locker. Majority of analysts, so 16, have a hold rating on the stock right now. I think given the environment right now, given the fact that consumers are pulling back their spending, the turnaround, yes, it is in motion, but I think it's far from over. There's still lots of questions out there there about what exactly Foot Locker is going to look like here.
Yeah, and it's clear the street loves Dylan. Wedbush was out with a note last week saying that this refresh was really needed, and she's really come in there. She's elevated their executive suite. She's really tried to streamline the business. But my question is, do people still go to Foot Locker? I don't.
I agree with you there.
I don't know.
And that's where Nike has such a distinct advantage in terms of their digital operation, which is where people are buying sneakers, proverbially on that sneakers app. That's where we buy them. You're right. It's a good point.
Unless they have the huge drops, then you're seeing those lines down the block all over New York City at their Foot Locker location right in Manhattan. All right, well, coming up next, there is still plenty of market movement in the aftermath of the latest Fed decision. And looking at gains here across the board, the Nasdaq up just about 2%. We'll be right back. Stocks moving higher here. Looks like the S&P and Nasdaq at least holding on to gains. You're looking at the Dow well off the lows of the day, was off over 500 points at the lows. We're looking at the action now after the Fed's recent decision to hike rates by another 25 basis points. Taking a look at that market reaction, the S&P up just about 1%, and it was down nearly 1% at the lows of the session. The Nasdaq up just about 2% here, adding to earlier gains, also boosted by some of those strong earnings reports that we got after the bell yesterday and ahead of the opening bell today. Well, coming up, we are counting down to the closing bell on Wall Street. A deeper dive into some of these moves when we come back.
All right, we're just a couple of minutes away from the closing bell on this Fed day. Jared Blickery here to break down the market action, which has been very interesting after Jerome Powell began speaking. It's been a wild ride.
It has, and it's not all about the Fed, also about earnings. We got to talk about some of these. AMD, after the bell yesterday, up 12.5%. This is leading chip stocks higher, catapulting the stock above its 200-day moving average for its best day since November. That's after delivering a surprisingly upbeat revenue projection, capitalizing on its headway into the server market, which is making up for lower demand in PC chips. Now, Credit Suisse rates the stock outperform and upped its price target to $96 from $90, saying that the results are a relief to investors after Intel's very cautious report only a week ago. Now, we also have to look at the social media sector because we're taking a look at Snap as well. Let's see if I can find this stock here. It's going to be one of the smaller ones on this board, and here we go. It's down 4.5%. Let me just show you a one-year chart right there. So Snap is plunging over 10%, well, 5%. That's Match Group right now. See if I can find Snap. That's going to be on, there we go, 10%. That's a one-year chart right there. That's after the social media company delivered disappointing guidance, leading Benchmark to downgrade the stock to hold, reasoning that Snap is behind the curve when it comes to surging ad dollars. Now, Piper Sandler, that rates the stock a neutral with a price target of $9, is a bit cautious on the stock despite management trimming expenses. They're saying while cost cuts were the right move, the business remains challenged. And so taking a look at the stock very well within the lower end of its range, not much of an uptick here at the beginning of the year like we've seen in so many other stocks. Now, let's get to Match, which looks very similar here, but I'll show you what. Year to date, it's actually up about 24%, so not bad right there. Now, Match Group rounds out our earnings batch, tumbling the most since December, but hopes for a turnaround in the relationship-building site, they are looking shaky, with the company saying that its business fundamentals are not improving. RBC, they rate the stock and outperform with a $75 price target. They're saying that Match should build momentum this year. They want to see cost discipline at the company, and they're going to be expecting better operating income margins going forward. Now, let's take a quick look at the Nasdaq 100 because we got some earnings after the bell coming here in just a few seconds. And guess what? Meta up 2.5% right after the bell. Stick with us, guys, because we got that right here.
All right, well, that wraps up what has been a wild trading day. All three of the major averages, it looks like right now as we shake out the final trades, are going to end in positive territory after the Fed raised rates by another 25 basis points. You're looking at the Dow up just 8 points, barely above the flat line, but we'll take it. The S&P up just about 1%. The Nasdaq, the outperformer of the day. It's really what the theme that has been this year. You're looking at the Nasdaq up just about 2% on the day. All right, let's take a look at some of the winners and losers of the day. First up, I want to take a look at Baidu because shares popping today after an SEC filing revealing that asset manager BlackRock has upped its passive stake in the company to 6.6% as of last quarter. That's up from about 5% stake a year ago. You're looking at gains of just about a 13%. And Dave, this news coming after we certainly have seen this rising interest in ChatGPT, in AI. Baidu has been named by Bloomberg earlier this week. There was a report out that they're planning to roll out a ChatGPT-like service next month, which is going to be huge here for the company if, in fact, that is true.
Yeah, Reuters says that is indeed true. Rolling it out by March, it'll be a standalone service and then fold it into their own search over time. Also a winner here as related to that could be Pinduoduo, who finished the day up more than 5%, largely on the heels of Baidu. On the loser, I get the loser. That's Electronic Arts, EA, a trending ticker on Yahoo Finance, falling. Look at this, folks, almost 10% today after execs disclosed the gaming company missed on holiday sales and its early guidance for next year came in lower than expected. EA also announcing it's shelving the mobile versions of two very popular games, Apex Legends and Battlefield. The moves are expected to result in layoffs, but no numbers were provided in terms of how much they would reduce headcount. Electronic Arts also announcing a delay. This was late yesterday of Star Wars Jedi Survivor from March to late April. Overall, look, that whole gaming sector has been just pounded coming out of the pandemic when you saw people staying at home, playing more games. Dramatic increase like a lot of tech companies, although they didn't bounce back the way big tech has. Gaming looks like a tough road ahead.
Gaming certainly does look like a tough road ahead. When you take a look at the analyst reaction here to these results, Cowen saying that there was disappointment across the board. Hopefully, though, they were saying that management has really set the bar low, because when you take a look at EA's performance, at least in 2022, they fared much better than many of its competitors. It was in negative territory. It was off about 7%, but comparing that to the losses that we saw in Take-Two, clearly just a drop in the bucket there. In terms of the loss that we're seeing today, the worst one-day performance that we have seen in EA since February 2019. We talk about gaming. We talk about the fact that the consumers are pulling back on their spending. Many of these companies have been under a tremendous amount of pressure now for quite some time, and that drop today puts it just around $116 a share, flirting with that $100 level, which we know is so critical here for that company. But Dave, when you take into account that consumers are pulling back, I think the big question is where that growth is going to come from, and where not only gaming is positioned in all this, but all of those consumer-facing names.
Yeah, it's just going to be a very difficult road. I mean, there's no different way to spin this than the way I just did. Look, it was skyrocketing for those years. People stuck at home and playing games, and then coming out of the pandemic, we're not seeing this same bounce back that we're seeing from Amazon, that we're seeing from Meta, that we're seeing from most of the tech giants as the Nasdaq continues to outperform the Dow and the S&P. And largely speaking, that whole gaming sector has been left behind, and you're seeing that in some of the chip stocks early on as well. Dan Halley, you want to chime in on this, my friend, on terms of Electronic Arts moving forward, cutting a couple of mobile games, delaying that Star Wars game, and the road ahead for EA?
This also isn't the first time that they've delayed the Star Wars game. And look, delays happen in the video game industry, obviously, but part of the problem with what we saw in 2022 was that so many games were delayed. And so we figured, okay, they're going to go into 2023. We'll start to see the games happening in 2023. And now there's further delay. So this is a larger problem. EA isn't the only one that does cut games. Ubisoft had cut games prior to this as well. One of their big games, Skull and Bones, was also delayed again, something that they've had happen before. And so, this is going to be something that I think is going to hound the gaming industry going forward. The good side of this is, at least not necessarily for EA, but for gaming in general, is that, look, Sony says that PlayStations are available now. Not necessarily good for them. There was a report that the PlayStation VR 2 isn't getting as much love as people had hoped. There's not as many people signing up for it. Sony basically said that's not true. People still want it. Microsoft doing relatively well, but they're not putting out enough games that people necessarily want. We're still waiting on some big names from them. I think I read yesterday someone was like, we've given Microsoft the benefit of the doubt for too long in gaming now.
Well, the good news is for Microsoft, they are the ones that are going to benefit from ChatGPT, $10 billion investment there. We talked about how Baidu is launching their own version of ChatGPT, but the big announcement today is of a paid version of the AI, and that's been the big question. It's been free. It costs them, I think, around 80 cents per transaction. They haven't charged. Now they unveil a different format where you're going to pay $20 a month, but what do you get in exchange for that? Everyone will not have to pay, only those who want this Chat GPT Plus.
Yeah, so what it is it's going to be basically faster in responding to your queries. It's going to be essentially an upgraded version of Chat GPT, and you can still use the free version. You can sign up. It's free. It's not a problem at all. And so I think that's something that we're going to continue to see this evolve for some time, but it's not necessarily, this isn't the end all be all.
All right, Dan, sorry to cut you off here. We just want to jump in with Meta earnings because they are out. So let's get to the numbers here. Taking a look at the stock reaction, look at that. Up just about 12% here. Revenue coming in stronger than expected, $32.17 billion. The estimate in the street was for $31.65 billion. Facebook daily active users also better than expected, just at 2 billion flat. The estimate was for 1.98 billion. First quarter revenue forecast here from Meta. Revenue coming in they expect to see revenue of 26 to 28.5 billion. That was just in line with what the street was looking for at 27.25 billion. Another big headline here, $40 billion boost to the share buyback authorization here with the company. And again, you're looking at the stock here popping after hours, up just about 12%. Monthly active users, a slight miss there for Meta, 2.96 billion. The estimate was for 2.98 billion, so a slight miss there on monthly active users. But again, the huge revenue number, 32.17 billion. Also the fact that Meta announcing a $40 billion boost in the share buyback authorization. Some of the reasons why we are seeing the stock jump so significantly here in after hours trading. All right, stay with us. An analyst breaking down Meta's results when we come back.
All right, earnings alert here. Investors hitting the like button on Meta earnings, up 13+% after hours after the company released its fourth quarter earnings. Share buyback, revenue beat. Dan Howley here with the most surprising thing you saw in this report. What do investors like, sir?
Yeah, obviously the stock buyback is a big deal, but there's some numbers here that are pretty interesting, and I just want to go over them real quick. I think, obviously the Reality Labs, we have that operating loss of $4.28 billion, still plowing money into that endeavor. Whether or not that'll pay off, and if it does, when, we still don't know. But you look at the Reality Labs revenue was $727 million. It's better than beat estimates. Family of apps revenue, that beat estimates. Advertising revenue, that beat estimates. So it's interesting to see that and as Shauna previously pointed out, monthly active users missed on estimates, but not by too much. I think it's interesting the fact that we saw Snap, kind of with this dire warning yesterday of their next quarter, but Meta seeming to kind of pull it out of nowhere and do so well here by beating on both the top and bottom line.
Looks like a Snap problem, not a sector problem from what you're seeing right now.
Or it could be that Meta has managed to flesh out those problems with Apple's privacy changes, right?
Yeah.
Maybe they've gotten a hold of that, and Snap is still trying to work through that. Don't forget, Meta's been, investing more in AI. They're, really trying to compete better with TikTok as far as that recommendation algorithm. I got to tell you, I use Instagram, and it seems to be doing that, as well as TikTok does now to a degree. It might not be as sticky, and obviously kids are still more interested in TikTok than they are Facebook, where their uncles yell at each other, or Instagram, where their mom posts pictures of themselves. But I think it is a solid step up for them. I think for this quarter, just to see their advertising revenue really pick up again.
Yeah, certainly. It looks like a strong quarter here for Meta. The stock now up almost 15% in extended trading. Dan Howley, thanks so much. We want to turn to Brent Thill, Jefferies equity research analyst, joining us now with more on these numbers. Brent, I know you've only had a couple of minutes to look at it, but let's start with revenue there. A beat in terms of what we were expecting on the street, $32.17 billion. Your reaction to that, maybe some of the weakness in the ad spending market, is that starting to level off?
Yeah, look, the expectations were so low that ultimately it's not like these are stellar numbers. They're just better than expected, 2% better than what the street wanted for the Q1. Q1's actually ahead by 5% above the street. So revenue looks good. I think what's more encouraging is the expense cuts. So they're cutting their expense guide by $5 billion and CapEx by $4 billion. Remember, this is a company that last quarter, everyone was like, what on earth are you doing, Mr. Zuckerberg? This is crazy. And then 2 weeks later, he pulled back the throttle, which was at 12 on a scale of 10. He pulled it back to a 9, and now he's back at a 7 on expenses. So he's clearly listening to Wall Street, listening to what we all want, and saying, look, we don't need, the headset walking around a virtual reality world right now. What we need is the platform on Instagram, which is driven by advertisers, to be better. And I think ultimately what this demonstrates is that, he's listening. They pulled back the throttle on expenses. No one's going to do backflips over the revenue growth, but ultimately now you have a better top line. You have a way better expense bottom line, definition of a beat. And again, a very cheap multiple that had, a terrible year last year. And, we were wrong last year. We thought, things wouldn't be maybe as bad. And so I still think we're not out of the woods with the economy. We're not out of the woods with ad spend. I think clearly Facebook's and Meta's going one way and Snap's going the other way. And so that there is some share gains, and we'll see, I don't think TikTok is disappearing, but certainly they were behind. Maybe part of this is playing a little catch up to TikTok.
Investors certainly cheering the $40 billion share buyback. What's the most concerning thing you've seen in this report so far?
Well, you just flashed a headcount number. I don't know the percentage. I haven't calculated that, but if that's right, that's still a pretty high net add in terms of employees. So I'd say margins, are a concern. We're keeping an eye on that. I think clearly, going into this, the stock was already up 27% year to date. Now, with the stock close to 180, you've had a very material move. So, I would just be cautious as it relates to anyone kind of, jumping in the pool right after this. We've had a massive move, and the move started when he pulled back on the expenses. When he came back to all of us 2 weeks after, he said he was going to spend like crazy, saying, well, maybe I won't be spending like that. So I would just be concerned about the magnitude of the move of the stock, number one. Number two, the expense structure still. And I'd say number three, look, we're not out of the woods on the economy. I think every economist is saying that we're still in a tough environment and that it could get worse as we go throughout the year. At least many of the economists are saying. So we just got to keep an eye on that.
But what do you make? Well, in this release, Zuckerberg touting the engagement that they're seeing on their apps. He also talked about the AI discovery engine, Reels being major drivers of that engagement. What do you think about the progress, more specifically, that has been made on Reels and the opportunity that presents Meta here going forward?
Yeah, Reels is really caught up. I mean, I think any of us that spend time on Instagram, there's some Reels I get that I'm kind of like, why am I getting this? And the next thing you know, you've wasted 15 minutes getting sucked into some ski video or golf training aid that you never had intention of getting involved with. And so I think ultimately it's making progress. I went to post a story about my family on Instagram the other day, and it says, hey, would you like it turn it into a Reels? And it put some rock music to it. And it was like 3 clicks, and it was boom, it was up, it was a video. And it was like, it took me 10 seconds to do it. So from a user posting content and creating a reel, super easy, way easier than before. And then on the other side, I think engagement is going higher, and you can see it when you talk to anyone that uses Instagram. If you use it, you know what I'm talking about. You get sucked in, and then next thing you know, you see the ad for the Gulf training ad. You see the ad to go to Portugal. You see the ad for the cruise line. Like, that engagement is very good.
And this may be difficult to quantify, Brent, but are they getting through the Apple privacy changes? Are they beginning to get to the other side of it?
That's done. That's done. They're on the other side. That was in all last year. That was clearly an avalanche of headwinds that they've now figured out. We're lapping through that. And I think, look, anyone that was on Instagram and that had been giving them the accurate data of who you are and what you like is only seeing incredible targeting, which is what I want. I don't want to tell the system I'm 80 years old and I get a ad for a bathtub that the side of that bathtub opens. I don't need that yet. I will at some point, but I don't want to see that. So my point is, like, the initial people that were onboarding or surfing the platform, yeah, it wasn't maybe as good, but I think, look, it's only gotten better for me as a user. I think your reporter also mentioned his experience too. So those of us that have been using it are only finding what I would consider insane targeting, better targeting, and better ad placement than anyone. So if I care about the band or sports or whatever, like, that's why I'm on the platform. And there's a lot of other platforms that do not give that to you. Snap is one of them. Just the usability is just not exciting. And so I think there's a lot of other social platforms that, Facebook and others have said this, that their ability and their size and their scale to fight through the Apple changes, they'll come out on the other side. It feels like we're coming out on the other side of the tunnel right now. I just don't know if we're about to go into a tunnel that's dark because advertisers now start to pull back because of the macro through this year. And that's still the big worry that we're keeping an eye on. And then again, the magnitude of the move now with the stock at 180, now we're talking like, gains of pretty much outperforming almost any tech stock year to date. That's a concern, the magnitude of this move.
Brent, what about the $40 billion in buybacks here? We know 2022 was the worst year on record for Meta. The timing of that and what that really signals here to investors. Obviously, a little bit of confidence, you would think.
Yeah, I mean, look, it's nice that they are able to move forward with a fitness app, which I thought was crazy. The FTC would fight this, but they got a victory. Which is, look, there's only a couple uses of cash. This company has incredible margins, incredible scale, but I think the fact that they're saying, look, they can't really do a lot of M&A. What are they going to do? They're not going to pay a big dividend. They're going to use it for buybacks. And so Google's been doing this. The rest of the industry is doing this. They can't really do any transformative M&A, so they're going to plow their excess cash back into their stock. And given where tech stocks went, look, it was an awful year last year, and look, none of us got all these right, but it got over bearish, and we're seeing a massive inflow back into tech. And you're seeing it again. Pull up the XLE. The energy index is flat year to date. Internet and semis are ripping up 20, 30, 40, 50%. So I think we have a restructuring of institutional money back into tech. Everyone's still offsides. No one's back where they want to be, and I think we're gonna see that. So the buyback again is helpful, but remember they've been buying stock back for a long time, and every quarter they made a commitment to the buyback, but no one was listening. It's just the sentiment on tech was so bad. And now all of a sudden overnight, it's amazing. So I think, it's incredible how fast things change on Wall Street.
What will solidify your buy rating from the call? What's that one thing you need to hear?
I think Zuck got that, the metaverse is not the end all be all, that us all having virtual reality glasses or headset and going into an alternative world is not the end all be all. That at the end of the day, there are great brands that want to advertise on this platform. That's 99% of the revenue, right? So the reaffirmation back to the core, number one, and then number two, the expense. They have been spending a lot of money on things we don't know what it's going to be, but he's clearly completely changed the trajectory by cutting the expense guide by $5 billion and CapEx lower by $4 billion. So the commitment that they can continue this cost discipline. Every tech investor right now doesn't really care. They understand the revenue growth is decelerating. They want to ensure that the thing that they can control is the bottom line. So that would be another big focus that we're gonna be listening for.
Looking forward to that. Jefferies, Brent Thill, always good to have you, sir. Thank you.
Thank you.
Coming up, President Biden meets with House Speaker Kevin McCarthy to discuss the debt ceiling. We'll tell you if anything might come out of it. And Ford might be trying to appease Mustang Mach-E owners who missed out on the vehicle's recent price cut. We'll have the details for you. Fed Chair Jerome Powell making it clear he says Congress needs to raise the debt ceiling.
There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
That's what we call definitive, folks. Those comments came ahead of a big meeting between President Biden and House Speaker Kevin McCarthy at the White House. This is their first one-on-one meeting in this new session of Congress. McCarthy said to be pushing for yet unspecified spending cuts. Senior columnist Rick Newman here with what might go down when these guys meet. Look, it's not entirely clear. It's been clear that the Republicans want some cuts.
Right.
But how far are they willing to go is the question.
Yeah, they've backed themselves into a corner already because while they might sound popular in theory, we should cut spending, the government is too bloated and so on, when you get to the specifics, spending cuts are very, very unpopular. And if you just put together the big pieces of the federal debt, or the federal spending, you can figure out why. So first of all, Medicare and Social Security are 1/3 of all federal spending. Cutting those is so unpopular that McCarthy has already said those are off the table. So that leaves, so you've already eliminated 1/3 of spending where you're not going to cut there. So you have to look at the other 2/3. And a big part of that is defense, which Republicans don't want to cut. So they're probably going to say that's off the table too. So, I mean, there just isn't that much left. What they're probably going to go after, which is what Republicans often do, is try to figure out ways to cut Medicaid. That is the health program for the poor and other types of some other health care funding. But that runs into tons of opposition too for lots of reasons. So to cut Medicaid spending, you cut payouts to doctors. And the doctors lobby says, hold on a minute, they're already so low we don't want to take Medicaid patients. You cut aid to the states and you get the states saying, no, they all have lobbying groups in Washington say, you're not cutting our payments, cut somebody else. So once this exercise gets underway, the way this works in Washington is everybody's fine cutting spending that goes to somebody else, but nobody's fine cutting the spending that goes to me. And that's why there are not going to be any major spending cuts at the end of this process.
It was a pretty definitive statement from Jerome Powell. Yeah. You almost wish he was in the room, right, with those two. What has Biden's negotiating position been leading up to this meeting?
That there will be no negotiations. And I think he's going to come pretty close to getting that. So everybody should know that even though we have to talk about it on the shows, we have to cover this for the next 4 months, we're not going to have a default on U.S. obligations. The debt ceiling is going to get raised. And the most likely way this is going to go down is there might be something like a new commission to study some ways to cut spending and get the debt problem under control. I mean, we do have way too much debt, but that's the fault of both parties. Going back 20 years, Republicans cut taxes too much. That doesn't boost the economy the way they say. And then we have all this spending in the COVID bills. Some of those were bipartisan, some of those were Democrats only. So this is a bipartisan problem. And we're not going to get one party in what is in effect really a majority of one party, what you might call 50 or 100 hardcore Republicans in the House of Representatives solving this problem. It's not going to happen.
And hundreds of billions, it looks like, of fraudulent spending in terms of that COVID, but the hearings will begin soon on that.
And we're not going to get that money back. I mean,
right, that's gone. And the debt ceiling argument is really over past spending. That is money, bills to be paid, not future spending. Rick Newman, good to see you, sir.
Thanks, guys.
Thank you.
All right, well, Rivian laying off 6% of its workforce in an effort to achieve profitability amid a growing price war in the EV market. Senior autos reporter Prastu Ramanian joining us now with more. And Prastu, it's certainly a tough setup here for Rivian because we have the price war that's brewing, also just a challenging economic environment right now.
Yeah, I mean, $90,000 trucks are not exactly an easy sell sometimes, but we confirmed that they are laying off 6% of their staff here. Non-factory jobs, it's going to be operational people, marketing people, people like that in their corporate offices. So really all about cost control, controlling expenses. You know, they want to build these cars cheaper, and they're kind of getting killed on margins here. So it basically kind of follows their second round of layoffs they had earlier last year. And the company also dropped this deal with Mercedes to build EV vans. They're pushing back their cheaper R2 vehicles. So really just the effort to conserve cash, focus on building these cars cheaper and getting them to customers as soon as possible.
Boy, it is a nice looking truck, isn't it? We see on that video.
We had it. It was great.
Oh, man. Ford also took a page out of Tesla's playbook. It is cutting the price of its Mustang Mach-E crossover, but there's a big difference. What is it?
So in the release, the bottom release yesterday, talking about the Mustang Mach-E price cuts, ranges from $600 to $6,000. Talking about how if you've not gotten your car yet and you have an order in, you'll actually have those price cuts honored. But also, if you've actually taken delivery on January 1st of this year, they're going to retroactively, they'll contact you directly about some sort of, compensation, right? So, I talked to some experts recently and they said that, for the smaller price goods, it could be, maybe free EV charging, something like that. But for the larger, $5,900 price cut, you might actually get a check cut to you in that amount. So that's a pretty big deal. Something that Tesla's not doing. They said if you bought the car a day before, we're not going to honor that for you, right? And then another potential big wrinkle is that it might bring you underneath the cap for the IRA. So not only are you going to get that price cut, but also maybe a $7,500 tax credit. So really big kind of double whammy in your favor if you're a Ford Mach-E owner that you're not getting from Tesla.
Massive, and you would be very, very pleased if in fact you do get that if you recently had bought this vehicle. Praz, we have Ford reporting before the bell tomorrow. GM was earlier this week. Very, very strong results. What are we expecting to hear tomorrow?
Yeah, it's a good point. GM really knocked it out of the park, so Ford kind of has to have a repeat sort of back-to-back sort of showing here. Looking at a high level, $40.6 billion for the quarter. That's up 15% year over year, and then adjusted EPS around 62 cents a share. But really going to watch that EBIT guidance. Do they hit their 2022 numbers? What's it going to be for 2023? And what about margins? Are we going to see these sort of price cuts and discounts affecting their margins, which are going to be probably around 7% in 2022? We mentioned the Mustang Mach-E price cuts, but also Ford might have to sort of discount some of their higher priced truck offerings. We heard last quarter that John Lawler, CFO, talking about how people were actually getting lower trim trucks in order to get the car they wanted, but they just couldn't afford, the Platinum version or the King Ranch version.
Yeah, that Ford F-150 Lightning has been selling like hotcakes. Praz Subramanian, Shauna's laughing because
You love it. Whenever we can talk about it, we do.
I heart you, Ford F-150 Lightning. Thank you, Praz. Good to see you, man. Coming up, we'll tell you how to play ETFs following the Fed's 25 basis point hike and a trio of tech giants reporting earnings tomorrow. We break down the key things to watch for Alphabet, Amazon, and Apple. Welcome back to Yahoo Finance Live. The big news shaking up Wall Street today, of course, the latest Fed policy decision. Jerome Powell, the central bank, raising rates by 25 basis points as investors come up with the game plan to successfully navigate the latest change. To help us break down what this means for the ETF industry, we're joined again by Todd Rosenbluth, VettaFi Head of Research, in this week's ETF report brought to you by Invesco QQQ. Good to see you, sir. What does today's announcement and most importantly, the language from the Fed chair mean for the industry, for investors in ETFs?
So 2022, we saw a strong year for fixed income ETFs. Almost $200 billion of money flowed in, and we've seen a really strong start in January to fixed income ETF demand. But what's happened is investors and advisors in particular have pivoted. They're willing to take on more interest rate risk, and that's what they're telling us at Verify. We recently held a survey of advisors, and more than half of that universe of advisors plans on taking on interest rate risk over the next 6 months. So they came in to the year, coming into the Fed meeting, as we're showing, expecting that the Fed would start to slow down its rate hikes and perhaps even cut later on in the second half of the year. You can see just 14% plan to actually shorten the duration or reduce the risk side. And so what that means and what we're seeing with ETFs is an ETF like TLT, which is the iShares 20-plus year Treasury ETF. That ETF has been in strong demand. Investors are willing to take out that extra risk and earn that extra income. So we're seeing demand for that ETF, and as you can see, it's performed well. As investors expected the Fed to be more gradual going forward, we've seen other fixed income ETFs be in demand that take on additional risk, whether they're corporate bond ETFs like LQD from iShares or Vanguard's VCLT, also seeing strong demand as investors are willing to take on that risk now that the Fed seems to be more patient going forward.
Certainly does seem like investors are taking more of an interest in fixed income into those longer-term ETFs. Todd, what about some of those tech-focused ETFs? Because we certainly have seen a massive run-up in a number of those stocks since the start of the year. Is that being reflected in the ETF market as well?
We are starting to see investors rotate into more of the growth-oriented strategies, and in particular, we saw, I think, QQQ be popular with investors. But I just want to highlight for investors that have watched Meta report results today with strong numbers, or that are anticipating what's going to happen with Amazon or Apple or other companies. Technology ETFs own Apple and Microsoft. So an ETF like XLK from State Street or VGT from Vanguard, it does not own Meta. Meta is a communication services company under the vernacular of the GIC structure. You would find it in an ETF like VOX or XLC. Amazon is a consumer discretionary company. You'd find in XLC or VCR, to just name a couple of tickers. So it's important to know what you own within a portfolio, and that's something we at Verify are trying to educate investors and advisors to know more than just the name of the ETF, but look inside the portfolio.
And lastly, Todd, Morgan Stanley launching 6 ETFs. Anything make them stand out to you in particular?
Well, they are the largest firm to not have an ETF presence. So we're excited that they were launching ahead of the Verify's Exchange ETF conference that's taking place this weekend in Florida. There'll be almost 2,000 registrants that are there. These ETFs from Morgan Stanley are under the Calvert brand, so ESG-oriented. Advisors respect that Calvert name. These products are relatively cheap. They're going to have the scale advantages. And so we're seeing here one of the actively managed ETFs that investors can rotate in, actively managed fixed income ETFs to connect the dots earlier. But Calvert under the Morgan Stanley brand, we think they're one to watch in 2023.
All right, Todd Rosenbluth, always great to have you. Thanks so much.
Thank you.
Well, it is a big tech trifecta. Amazon, Apple, Alphabet, all reporting after the bell tomorrow. Here with what we can expect, we have Yahoo Finance's senior tech reporter, Ali Garfinkel, and tech editor, Dan Howley here. We've got all of your bases covered because tomorrow is certainly going to be a busy day after the bell. Ali, let's kick it off with you. Ladies first here, Amazon. I know you're closely watching those results. What are the most important things we need to know?
So thank you, Shauna. Ladies, I like ladies first. So I want to jump right in to start by talking about cloud. I've sort of identified 3 things, but I want to start with cloud because it has been a stalwart of Amazon's business for so long. But in this key quarter, they are fighting an uphill battle when it comes to cloud. AWS has done well for a long time, but we only need to look to last week to see some doom and gloom. In Microsoft's earnings call, the company warned of decelerating cloud growth. So that doesn't read through great for Amazon. Second thing to watch, key retail growth. Retail growth would be a major step in demonstrating the resilience of that business. I was actually looking at some data that was compiled by MasterCard, and it said that U.S. e-commerce sales increased 11.3% year over year this quarter. So it's desirable and possible to see that retail growth. The last thing is keep an eye on margins, both in ads and in retail. So They've laid off a lot of people, 18,000. There's going to be increased pressure on them because of those layoffs to get margins right. Also, if growth continues to be slow in retail and ads, those margins are going to matter maybe more than ever. Bottom line, after a rough year for Amazon, I'm laying out what success looks like, but they're not the only ones who've struggled.
All right, ladies, first, I guess that leaves us, I don't know, second.
You guys on the curb outside, you know?
You're looking at Apple, and when it comes to Apple, you've got your eye on China and the impact of the COVID lockdowns. How much do you think it did impact demand?
Yeah, it seems to be that there's the story of the China lockdowns and the issues with availability and then demand. So it seems to be that there's these two kind of coming together to be a larger issue. And right now we're looking at expectations of iPhone revenue to be $68.3 billion. That would be below what we had last year at $71.6 billion. So overall, the projections are for revenue to be lower for the first time in 2019. Since 2019. Since then, if you go back and look at all of Apple's reports, it's record quarterly revenue, record quarterly revenue, record quarterly revenue. So we're going back to 2019 when they actually saw a decline, a year-over-year decline. And that's because of these problems here. We're looking at the broader smartphone market, down 14.9% as far as Apple iPhone shipments go globally. That's 85 million units. And so, this is from IDC's global smartphone tracker. It's not Apple's own numbers. We'll find out more about that tomorrow after the bell, but that's a great indicator of what's going on. And they saw, the market in general decline, though Apple market share rose. So that's, it could be offset, but, Mac revenue not expected to do particularly well. They didn't really introduce any new stuff for the Mac in the quarter. We just got that in the past few weeks, and then iPhone revenue. So, we're looking at this Q1. It includes the holiday season. It's not great when, the holiday season for Apple if we're talking about lower year-over-year iPhone sales.
It's certainly not great. It's tough, but Ali, you can't necessarily count Apple out. They deliver time and time again, it seems like.
No, you really can't count Apple out. And we've seen it over and over again. It's a bad time in the market, and then Apple makes it through. That said, they are dealing with some issues they haven't dealt with before. For instance, the China problems, and for example, labor issues that they've been reportedly fighting against hard. So tomorrow's going to be a big day for all of us, and especially Amazon, Alphabet, and Apple.
Yeah, well, you mentioned Alphabet there. That, of course, is the third big tech story that we will be watching. The list goes on and on and on. Cloud growth and ad revenue are going to be in focus there.
Yeah, I'm going to need a drink after tomorrow.
We all will.
Yeah, we're looking at revenue ex-TAC, which is revenue with the exception of traffic acquisition costs. That is expected to come at $63.2 billion. That's going to be better. Potentially than what we had last year, $61.9 billion. Earnings per share is going to be kind of difficult to get out immediately because they had that 20-to-1 stock split in July. So you can't really compare $1.20 to $30.69 that they had last year. But we're going to be looking at what happened as far as YouTube ad revenue goes, and then general ad revenue. So now we have this mixed picture of the digital advertising market, and I saw some folks tweeting, this is a vindication of the digital ad market because of Meta's results. Well, then what happened with Snap, right? So is it that, like I said previously, that Meta figured out how to get past the issues that arose with Apple's privacy changes? Or is it that Meta just happened to do well and, Google won't? So we have to, or Alphabet won't. We have to see where that goes. But I think once we get a sense of where Alphabet is, where YouTube is, we're also going to be looking at the cloud because they're trying to build that up. And, they're not making, I don't think they make any money off of that yet.
When it comes to the changes, Brent Thill from Jefferies said that is done. They are through it, and they have figured it out when it comes to Meta figuring out the Apple privacy changes. Dan, Ali, what are we drinking tomorrow?
Margaritas.
White Claw.
Okay.
Always White Claw. You love White Claw. Okay. I'll bring you a White Claw.
I'm going to go with this one here, okay? I'll bring you one of those.
Black cherry.
Look forward to seeing you guys tomorrow. Coming up, the Biden administration wants to dramatically cut down credit card late fees. We'll tell you what they're planning after the break.
Let's take a look at what's trending after hours. We got 3 stocks for you, and as you can see on your screen, a lot of green. Let's kick it off with Meta. We're looking at gains of just about 18% in extended trading. Revenue very strong for its most recent quarter, beating the street's estimates, coming in just above 32 billion. Daily active users was also better than expected, just at 2 billion flat. They also announced a $40 billion boost in share buybacks. Ad impressions during the quarter were up 23%. You're looking at an 18% gain in extended trading. If that holds through tomorrow's trading day, that will be the biggest intraday jump that we have seen since 2013. We know 2022 was a very, very tough year for Meta. Taking a look, though, how the stock has performed year to date, we're looking at gains of just over 27%. Moving on to Align Technology, that stock popping in after hours trading as well, up just about 15%. EPS and revenue both beating the street's expectations. If you're not familiar with the company, it's a medical device company. They're the owner of Invisalign, which of course has been very popular now for quite some time. The company also okaying a $1 billion buyback. I do want to note that the company did not provide full year revenue guidance. They did cite macroeconomic environment and also continued global challenges here as a reason for that. Year to date, you're looking at gains of just about 33%. But let's take a little bit of a longer term chart here and look at 3 months. 3 months, they're up still big, up just about 46%. And rounding it out with e.l.f. Beauty, that stock also popping up just about 11% here after hours. Certainly looks like people are spending money on cosmetics. e.l.f. Beauty beating the street's expectations here, boosting its full year EPS and sales forecast, beating on top and the bottom line. Over the past 3 months, looking at gains of just about 33%. So really bucking the downward trend that we're seeing more broadly speaking in the consumer discretionary sector there, Dave.
Okay, good job, Shauna. Thank you. The Biden administration announcing its latest attempt to crack down on hidden fees. This time, they're targeting credit card late fees. Oh, they are a nuisance. Here with the latest is Yahoo Finance's Carrie Hannon. Carrie, good to see you. What are we learning?
Hey, Dave. Yeah, they certainly are a nuisance. What the Biden administration is looking at doing is curbing the late fees on credit cards to $8, right? Now, this is what it is. The average has been around $41 for late payments, for missed payments and late payments. So this is a big deal because credit card companies, the Consumer Financial Protection Board, is put together this plan. It does not require congressional approval. They're publishing it in the Federal Register. And what it's going to say is now, like right now, the rule as it is now, credit card companies can charge 100% of the minimum payment that you owe them as a late fee. What they're hoping to do is bring that down, as I said, to curb it at $8, but also limit it to 25% of what that minimum amount due is. Now, remember, when people are paying this late fee, it's not only that you're paying that late fee, but you're also paying that incredible the percentage rate of the interest rates today, which are, in January, the APR, the average one on a new card was 23.39%. I mean, that is a huge amount. So if you have that on top of this late fee, it's really been very, very, onerous on the credit card holders. And this tends to really impact people who are in low incomes, that have low credit scores. So it just multiplies and the problem just gets worse. So I think this is a really important move that they're making. And, rates have been on the rise. These late fees have been on a rise since 2010. So an attempt to kind of take control of these.
Yeah, very important story. Thanks so much, Carrie Hannon. Coming up, the famous Tiffany Blue is coming to Nike. We'll tell you all about the footwear maker's latest collab after the break. Tiffany's legendary little blue box gets a bit bigger when it meets arguably the world's most recognizable logo, the swoosh, and what they're calling a legendary pair. Images leaked of the forthcoming Nike x Tiffany & Co. Air Force One 1837s set for release on March 7th. The killer collab comes in black suede, accented by sterling silver badges on each heel. Tiffany's Instagram, as you can see, unveiling the Essentials kit, complete with a shoe horn, a shoe brush, a whistle, and something called a doubre, which apparently is a metal shoelace ornament sort of thing commonly found on Air Force Ones. The shoes are expected to retail for $400 at Tiffany's 2 New York City flagship stores, select Nike retailers, and the Nike Sneakers app, and will sell out probably like Taylor Swift tickets.
They certainly probably will, especially if you have anything to do with it. Well, LeBron James is the first to be seen in anything from this collaboration. He showed up to last night's Lakers and Knicks game in New York City wearing a Tiffany and Nike branded varsity jacket. Dave, this is something that I know you are very, very excited about. Why do you think that this is such a game changer and there will be so much demand for this? Because to be totally honest, I'm not sold.
Really?
No.
I actually think this might be the GOAT collaboration in the fashion industry. Because when I think of close second place would be Gucci and Adidas, which was a pretty big one. I just think you have, well, what you have is Nike, the world's most valuable apparel company, combined with LVMH, really the king of luxury brands in the world. And I think that, just that elite feeling of just next level, something I can't have, something that looks great, feels great. This will sell out in minutes on the Sneakers app, and we'll probably add a 0 to the price once they're sold.
You know what? I think I'm just not sold because the majority of the sneaker is black, which is the little swoosh there that has a Tiffany blue. I don't know if I might have designed it a little bit differently, but you're right. They're probably going to go out.
I wouldn't mind Tiffany blue suede with the white swoosh.
Yes.
Is that what you were thinking?
Yes, that's what I was thinking, and I think it would be a little bit nicer, but we'll see. All right, well, that'll do it for us today on Yahoo Finance Live. We had a jam-packed show today. Thanks so much for sticking with us. We'll see you right back here again tomorrow afternoon. Have a great night.
you